Everyone thinks they already missed Bitcoin. Some believe the bull market is over. Others think the easy money is gone forever. And after months of brutal volatility, millions of investors have quietly given up. But what if this is exactly how every historic Bitcoin rally has started? Because one veteran macro investor believes the biggest move hasn't happened yet. Not when Bitcoin first crossed $100, not when it hit $1,000, not even when it smashed through six figures. According to Lawrence Lepard, the move that could redefine global wealth may still be ahead. Not because Bitcoin suddenly became more valuable, but because the financial system itself is changing. His thesis centers on persistent government debt, ongoing monetary expansion, and investors seeking assets with limited supply. Lawrence Lepard has repeatedly argued that these long-term trends could create a powerful backdrop for Bitcoin over the coming years. And here's the strange part. Almost nobody is paying attention. Because while retail investors stare at hourly price candles, the biggest story is unfolding behind the scenes. Government debt is exploding. Liquidity is quietly returning. And history may be preparing to repeat itself. But there's one piece almost everyone is missing. And once you see it, you may never look at Bitcoin the same way again. Right now, somewhere between $58,000 and $62,000, Bitcoin is sitting quietly after one of its roughest stretches in years. The first half of 2026 started with Bitcoin trading above $93,000. By the end of June, it had fallen all the way down to the high 50s. Billions of dollars left the Bitcoin exchange-traded funds in a single month. And a lot of people who were confident a year ago are suddenly quiet. If you're one of them, you're not alone. And if you're new here, welcome. Because today we're going to look at why one veteran macro investor believes this exact moment, uncomfortable as it feels, might be setting up for something much bigger than most people expect. Stay with me, because the final piece of this puzzle could completely change how you think about the next few years. Before we go further, quick disclaimer, nothing in this video is financial advice. We're breaking down an investment thesis for educational purposes only. Markets are unpredictable, Bitcoin is volatile, and you should always do your own research before making any financial decision. Now, comment below and tell me, are you watching this on your lunch break, scrolling before bed, or checking Bitcoin prices for the 10th time today? I'm genuinely curious where this community is tuning in from. Let's get into it. The man who keeps asking a different question. Lawrence Lepard has spent years studying something most investors ignore completely. Not price charts, not candles, not the next 30 days. He studies debt, specifically government debt, and what happens to money when that debt keeps climbing with no real plan to stop it. His argument isn't complicated on the surface. Governments around the world are spending more than they collect. They borrow the difference. Then they borrow again to cover the interest on what they already borrowed. At some point, printing new currency becomes the easier political choice compared to painful budget cuts or unpopular tax increases. If that pattern continues, and Lepard believes it will, then currencies slowly lose purchasing power over time. Your paycheck might look the same, your bank balance might show the same number, but what that number can actually buy keeps shrinking. Now here's where it gets interesting. Bitcoin was built with a hard limit. There will only ever be 21 million coins. No committee can vote to create more. No emergency meeting can expand the supply overnight. That scarcity is the entire foundation of Lepard's thesis. Stay with me, because the next part is where a lot of viewers tell me their perspective actually shifts. Why this feels like déjà vu. Every single cycle, the story repeats. Bitcoin rises. People declare a new era. Then it falls hard, and suddenly the same voices call it dead. We saw this in 2017. We saw it again in 2021. And we're watching a version of it play out again right now in 2026, with Bitcoin down more than a third from where it started the year. Here's what they're not telling you in most of the panic headlines. Drawdowns of 50% or more have happened multiple times throughout Bitcoin's history. Every time, critics said the experiment was over. Every time, long-term holders argued the underlying thesis hadn't changed at all. Some of them were early, some of them were flat out wrong in the short term. But the pattern of extreme pessimism showing up right before major shifts is something Lepard has pointed to again and again. So ask yourself honestly, when you saw Bitcoin's price fall this year, was your first instinct fear or curiosity? Drop your honest answer in the comments. I want to see how this community actually reacted in real time, not in hindsight. Here's something that rarely gets enough attention. A decade ago, Bitcoin's buyers were mostly individual retail investors. People willing to navigate exchanges, manage private keys, and take on a technology most of Wall Street dismissed outright. That landscape looks completely different now. Some of the largest asset managers on the planet run regulated Bitcoin investment products. Public companies hold Bitcoin directly on their balance sheets as a treasury asset. Governments debate digital asset policy instead of ignoring it. None of that guarantees future performance. But it does mark a real structural shift from Bitcoin's early years, when it was treated as an internet curiosity. Lepard's argument here is subtle, and it's easy to miss if you're only half paying attention. He's not simply saying more people will buy Bitcoin. He's saying the entire structure of demand has changed while the supply structure has stayed exactly the same. 21 million coins, no matter who wants in. This is where it gets really concerning for anyone still thinking about Bitcoin the way they did years ago. Because if you're evaluating this market using an outdated mental model, you might be missing the actual shift happening underneath the surface. Let's talk about a word that sounds boring, but has quietly moved every major market for decades: liquidity. Think of liquidity as fuel for the financial system. When there's very little of it, borrowing becomes expensive, businesses pull back, and investors avoid risk. When liquidity expands, money starts looking for a home. Some of it flows into stocks, some into real estate, some into commodities like gold and silver, and increasingly, some of it flows into Bitcoin. Lepard has argued that over long stretches of time, governments and central banks face constant pressure to support financial stability, especially once debt burdens become difficult to manage without some form of monetary easing. If that pressure eventually leads to looser financial conditions, scarce assets historically tend to benefit. This isn't a prediction about next week or next month. It's a much longer-term view about which direction the tide is moving. And right now, with the Federal Reserve's next meeting scheduled for the 28th and 29th of July, plenty of investors are watching closely to see which way policy leans. Quick question for you. How's the weather where you're watching this from? Genuinely curious how global this audience actually is. Drop your city or country below. I read every single comment. Here's something almost every investor experiences, but rarely admits out loud. When your favorite product goes on sale for 30% off, you're excited. You call it a bargain. But when Bitcoin drops 30%, most people panic and assume something is broken. That contradiction is one of the strangest patterns in investing. People love discounts everywhere except in financial markets, where suddenly the same discount feels terrifying. Lepard has often said that successful long-term investing isn't primarily about understanding economics. It's about understanding human behavior, because markets are ultimately driven by people, and people are emotional. Fear spreads fast. Doubt spreads faster. And by the time an opportunity feels completely safe and obvious to everyone, prices have usually already moved. But you need to understand this before I show you what's next. Because the biggest wealth transfers in history rarely happened when everyone agreed. They happened when a small group of people were willing to look uncomfortable, hold their position through volatility, and wait while headlines said the opposite of what they believed. Hit like if you've ever felt that exact tension, wanting to buy something everyone else was scared of. Picture pushing a small snowball down a mountain. At first, barely anything happens. But the farther it rolls, the bigger it gets, until eventually stopping it becomes almost impossible. Lepard argues sovereign debt behaves in a remarkably similar way. Governments borrow, interest accumulates, old debt matures and gets refinanced with new debt. Deficits require even more borrowing on top of that. As this cycle continues, interest payments alone start consuming a larger and larger share of government budgets, making every future fiscal decision more difficult than the last. No household could operate this way for long. No business could either. But governments have tools that ordinary people and companies simply don't. The ability to tax, the ability to borrow at scale, and for countries with their own currency, the ability to influence the money supply itself. Faced with two options, painful spending cuts and tax increases, or supporting liquidity and hoping growth eventually catches up, history shows which path governments tend to choose more often, not because leaders want inflation, but because the incentives quietly push policy in that direction over long periods of time. This is exactly why Lepard has spent so much time studying gold, silver, and increasingly Bitcoin, assets whose supply simply cannot be expanded on command. Stay with me, because this next part connects everything we've covered so far. If governments continue carrying heavy debt loads, if policymakers keep leaning towards supporting financial stability rather than austerity, and if liquidity keeps expanding over multi-year cycles, where does some of that new money eventually go? A portion flows into equities, a portion into bonds and real estate, a portion into commodities, and a growing portion, according to Lepard's framework, flows into scarce digital assets like Bitcoin. He's not claiming Bitcoin is guaranteed to outperform everything else. He's making a much narrower point, that Bitcoin's fixed supply of 21 million coins, combined with a growing base of possible buyers, creates a mathematical setup that's fundamentally different from most traditional assets. Add to that the fact that a meaningful portion of existing Bitcoin is believed to be permanently inaccessible, with private keys lost over the years, and another large portion is held by long-term investors who rarely sell at all. That means the amount realistically available for new buyers on any given day can be far smaller than the total supply suggests. Some analysts describe this as a potential supply squeeze, not because Bitcoin disappears, but because willing sellers may become harder to find if demand rises even modestly. Comment below, do you think that supply squeeze idea holds up, or is it overhyped? I want to hear real pushback, not just agreement. Why most people still miss it? Here's the pattern that repeats in almost every generational shift. People dismissed the internet as a fad before quietly building entire industries around it. People treated smartphones as expensive toys right before they became essential to daily life. In every case, early adoption looked irrational until, almost overnight, it looked obvious. Lepard sees Bitcoin through that same lens, not as a guaranteed win, but as part of a broader shift toward digitally scarce assets in a financial world where creating more traditional currency remains relatively simple. Whether that view ultimately proves correct is still an open question, but it's the framework shaping his long-term conviction. And here's what they're not telling you in most mainstream coverage. The biggest financial opportunities rarely feel comfortable in the moment. They feel risky, controversial, and uncertain right up until the point where everyone suddenly agrees. And by then, the price has usually already moved substantially. The catalyst. Everyone's missing. So what could actually turn this long-term thesis into a real catalyst? Lepard's answer isn't found inside Bitcoin itself. It's found in the broader monetary system, specifically in how governments respond as debt keeps climbing and interest costs keep consuming larger shares of national budgets. If that pressure eventually forces more supportive monetary policy, and if liquidity expands as a result, scarce assets historically tend to be among the biggest beneficiaries. That's the mechanism Lepard keeps returning to again and again across years of interviews and public commentary. This is where it gets really concerning for anyone assuming the current downturn means the story is finished. Because according to this framework, downturns like the one we're in right now during the middle of 2026 aren't necessarily evidence the thesis failed. They're simply the uncomfortable part that comes before people can even consider agreeing on it. One of the biggest misconceptions in investing is that successful investors somehow know what happens next. They don't. Nobody consistently does. Not hedge funds, not billionaires, not economists with decades of experience. Lepard doesn't claim to know what Bitcoin does next week, next month, or even by the end of this year. His conviction comes from studying long-term incentives around debt, monetary policy, scarcity, and human behavior, then asking a simple question. If these forces continue in the same direction, which assets are positioned to benefit? That's a very different approach from trying to predict every price swing, and it's worth asking yourself the same question directly. Are you making decisions based on where you think the world is actually heading over the next 5 or 10 years? Or are you reacting to yesterday's headline? Share this with someone who keeps saying they missed their chance on Bitcoin. This entire thesis is built around the idea that the story isn't finished. It might just be getting started. Let's be honest about where things stand today. Bitcoin trading in the high $50,000s to low $60,000 range isn't the triumphant picture from a year ago when prices sat above $90,000. Institutional flows have been mixed, with heavy outflows from some of the largest Bitcoin funds throughout June. Sentiment among plenty of analysts has turned more cautious, with some price targets being cut rather than raised. But Lepard's argument was never built around short-term price action in the first place. It was built around a multi-year view of debt, currency debasement, and scarcity. Whether he turns out to be right is genuinely uncertain. Whether he's too early or too optimistic altogether is a fair question worth asking yourself honestly, rather than dismissing outright. What is certain is this. Every major monetary or technological shift throughout history looked uncertain, uncomfortable, and even a little ridiculous right up until it didn't. The people who studied those shifts early, understood the reasoning behind them, and were willing to sit with discomfort tended to end up in a very different position than those who waited for total certainty. So here's the real question to leave you with today. Are you paying attention to the forces actually shaping the future of money? Or are you only paying attention to whatever the price happens to be doing this week? Let me know your honest answer in the comments. Not what sounds smart, what you actually believe. If this breakdown gave you a new way to think about Bitcoin, debt, and where money might be headed next, subscribe to the Wealth Continuum. We break down the biggest macro forces, institutional trends, and monetary shifts shaping your wealth without the hype and without the noise. Hit that notification bell so you don't miss the next deep dive. Thanks for spending 20 minutes here with me today. And remember, the biggest financial decisions are rarely made once everyone agrees. They're made by people willing to understand what everyone else is still missing. We'll see you in the next one.